Hello, thanks for joining us on Technical Roundup. We've got a very exciting episode today. We're joined by Max Boonen of B2C2 Group, which is one of the biggest crypto market making firms, period, especially from the multi-jurisdictional point of view. I'm sure we'll hear more about that. We have a broad range of topics to discuss, especially focusing on Grayscale, the GBTC premium discount, what's going on. We'll hope to give you a decently comprehensive breakdown of this topic. I'm joined, of course, by Max as well as my co-host, DonAlt. Gentlemen, thank you for being here. How's everyone doing?
I'm all right. Thank you very much. Pleasure to be here on your channel.
Yeah, I'm good. Looking forward to this a lot.
Likewise, fantastic. So before we jump into the juicy details, Max, do you want to give us a bit of... This is always the most boring part of podcasts. I'm sure you may have listened to some. They're like, oh, tell us how you got into crypto. And it just goes on this 20-minute lecture, which people usually skip to get to the content. But in your case, your background's very interesting. Where do you come from? What do you do? Anything you want to share from the outset?
Yes, I started trading sort of by mistake. I had my first internship at Google, and I was quite young at the time. I was just 19. And Google they had an internal prediction market, like Augur is tried to do. And the employees could bet on some events related to Google, such as the number of employees that the number of users that Gmail would have, let's say, a year from now. And they were trying to aggregate what everyone thought by having some sort of trading game where you could bet on those events. You can think of that as binary options. And I created a little bot because I found there was a way to make free money. I didn't know what you would call that, but I figured out later, oh, that's what arbitrage means. So I started arbitraging the Google internal market, and I became the #1 trader there with my little bot. I was not a finance guy. I was really more like more of a maths guy, I suppose, and sciencey guy. And I thought it was quite fun. Obviously, it was all play money. You could win a teddy bear or something like that. But after my internship, I thought, well, maybe there's a way to do this with real money, right? Maybe there's a platform I could find. And I actually did find such a platform. It was called intrade.com. It was very famous at the time. Maybe some of you guys remember it. There's actually the last CEO of that platform. He's in crypto now. I think he's running one of the prediction markets or something like that, decentralized. But at the time, that platform was super famous for allowing people to bet on the US elections and a couple events like that, like the Academy Awards. And in 2008, it had predicted the platform because of the wisdom of the crowd and everyone trading, state by state, perfectly the US election of, if I remember, was Obama versus John McCain, I guess. And they got a lot of traction like that and lots of trading activity. And I was 1 year after my internship. So I thought, well, I'm going to create a model that's going to be smarter than other people. And you would say now, I'm going to be a taker. And a couple of days before I rolled out my sort of silly, simple algorithm, the main market maker on that platform, he just gave up. He said, guys, we had forums at the time. It was sort of the way that people interacted. He said, I'm not making any money here. It's not worth it. I'm just giving up. And that that sucked for me because I had my algo. I relied on liquidity in the market. And it got me thinking, well, if I think my sort of my fair value is good, maybe I ought to be making the market actually. So that's how I got into it. At the time I was 19, 20, something like that. And I was a student. So what was quite important to me, also considering I went to a big party school actually, that I didn't want to be in front of screens all day. So I made it very automated from the get-go. And that's also why nowadays with B2C2, everything started out, it's got to be super automated. So I had a very good run on that platform before, incidentally, it was actually shut down almost by the CFTC, because the CFTC told them, guys, all those contracts that you have, really they're like derivatives. Because you also had financial stuff. You could bet on gold and the S&P, the Dow Jones. And the CFTC said you have to stop accepting US citizens. And US users, obviously, they accounted for perhaps like 80% of the business there. So that was kind of, the platform went through a slow death. And then, and I thought about that a couple of days ago, actually, the founder of the platform, he actually died climbing the Everest. And I was reminded of that because of Quadriga, that exchange in Canada where the guy supposedly died in India.
Of course.
And I thought, wow, the similarities are crazy, right? It's a bit strange. So that was the end of the platform. They went bankrupt. Thankfully, I was able to get my money out. Also, some sort of parallel with crypto. It was kind of like the Mongox of prediction markets. A bunch of people lost money, and the big investors in the bankruptcy turned out to be like Paul Tudor Jones, Stanley Druckenmiller, and some big guys like that. And after that platform died, my flatmate at the time, he was a quant at Goldman. I was a rates trader back then. He told me, you ought to look into Bitcoin because those algos you used to have, and maybe you could do something with that new Bitcoin thing. And that was late 2012. So late 2012, I'm thinking, okay, that Bitcoin thing, what's that? It's like an asset. It's not got any sort of fundamentals. We don't really know what the value is. But I guess maybe what I used to do, Obama versus John McCain, it's not really got fundamentals either. It's a beauty contest. And so I started tweaking the algos a little bit to make them compatible with Bitcoin. And if I started Among Us. We lost a bunch of money when there was a crash from like 260 to 70 or something like that. Then there was another where they went bankrupt. So I was not so excited anymore after I lost something like 30 grand, which was a lot of money at the time for just an analyst at a bank. And it's in 2014 that I started being more active again, recoding on the weekends, trying to do something again. And in early 2015, I left my job, started doing that full time. I created like the B2C2 entity, hired a friend, Flavio, who's the co-founder with me. And we quickly became the biggest market maker in crypto. Initially was like Mongo was gone, but Bitstamp, then we had Bitfinex, and OKCoin was quite big. You had the Chinese exchanges with the CNY trading that lasted maybe a year there before they got shut down. And fast forward a couple of years, we opened the big OTC desk, and now we're part of the ecosystem. Sorry, I made it 20 minutes like all your other guests. I'm really sorry.
Not at all.
Yeah.
So you've been around for a while, right? That's probably the first thing to draw from that. Experienced participant. And so how would you describe the main day-to-day workings of B2C2 right now?
Well, so it's all about the machine. It's all about the machine. We wanted stuff to be automated as well, because if you want to make money in automated fashion, you want to be 24/7, because you don't know when the market's going to move. You don't know when there's going to be an opportunity. So early on, because Flavio and I, we lived in Europe, we wanted to be there for the Asian session, US session. So everything was all automated. In fact, our biggest day, when we started, that was in August 2015, we had a flash crash on Bitfinex. The price went from something maybe like $400 to $200, a big move even at the time. And we woke up, we had made $8,000 in one overnight. And we used to make something like $8,000 a month for the couple months that we had been trading. And we thought, oh, hold on a second, that's nice actually. The systems, they're able to withstand a big flash crash and not get run over. So that was always part of the philosophy. Everything's got to be automated. So a normal day at B2C2, you have a team of quants and traders, quant traders, because most of our traders, bar one, they're all coders as well. And some of them are more researchers. So a quant researcher is going to work on machine learning models and the like. The more quant traders are more going to be finessing with the models, changing parameters as the market moves a little bit, just kind of monitoring risk, right? Clicking some buttons. Really, we're all just fancy button pushes. And then you've got sales, obviously, for the client business, which represents the biggest part of what we do. Middle office, obviously, to support client activity. The compliance department, but most of the company focuses on around tech, where we've got quant traders, quant devs, and pure devs working on improving the algos, getting the latencies down, getting the network faster. It's really very similar to what you would find at a normal HFT, plus a sell-side bank, because we've got the client business. I think the difference is that the tech in crypto is a little bit different. We're not really fighting the same war that firms in conventional markets are. So that adds a twist, which I think is kind of cool, actually, especially given crypto is a bit of a level playing field. I really like that. So we pay for data at B2C2, but the only data we pay for is the CME. Because in real markets, you've got to pay for data and it's quite expensive, whereas everything else is free. That's something I think is really cool for crypto. Because even if you want to be a big market maker now and you want to have a client business, yes, you're not going to be able to do that unless you have a ton of capital and 50 plus people. But if you just want to run a strategy, you want to be more like a day trader, well, yeah, you can. Like two guys in a garage, if you think you have a good idea, you can just get all the data for free. You can connect very easily to those exchanges and you can prove yourself. I think that's really cool, actually. And that's something that, like, that ship has sailed in conventional markets for a very long time. But crypto, you still got that ethos, which I think, even if I'm not like a big Bitcoin evangelist, I think that's one of the features of the market that I really, really like.
Do you think that's going to maintain, or do you think that's going to chip away with the years?
I think it's going to maintain, because when you think of like a Coinbase, you guys have seen the news, IPO, $100 billion. Good for them. Why is Coinbase worth 100 billion? I think it's because they've got 20 million users. It's not because they've got a fast matching engine that caters to HFTs and whatnot. In fact, it was reported, was it summer 2019, that they had a team of 50 engineers in Chicago. They closed it all. They got rid of everyone. I heard it cost them something like 50 million that they put in that effort. And they just realized, I think, well, guys, yeah, we want to IPO, want to be a big firm. What's the real value? What does Coinbase bring to the table? And what it brings to the table is 20 million users that have made, for a lot of them, never traded. So they're getting in with crypto, but maybe you don't, I don't know, maybe in 5 years, you'll be getting your commodities trading or stocks trading on Coinbase. And so that's the value. That's all that user base. The fact that you have institutions also trading on Coinbase, I think it's a minor part of their business. And in fact, I think if you read that's called an S1, I think, right, with the SEC, with the filing, it really shows that their institutional business is not really big at all. And so all those platforms, that's the lifeblood, is the retail traders, right? So if you tell them, well, you're going to have to pay for data, and by the way, you're going to have like 3 tiers. You're going to have like institutional, and then medium, and then retail, and the retail guys get worse data. I think that just doesn't fly. It just doesn't fly. I think it would not be good, and the users will not take that kindly to give favor to institutions. I think fee tiers, where the more volume you do, the better the fees, that's one thing. But to actually have some kind of pay to play, I think that would not work. And so I don't anticipate that any of that's going to change for the foreseeable future.
Yeah, that's really nice. I like that fact a lot too. It's just, it feels like a smaller space and something that you can kind of put your hand on, while the traditional markets feel much less so, to me anyway. And I mean, I didn't really trade the traditional markets before crypto, so maybe I'm naive on that front, but I felt like it was much easier to get information in crypto than in the traditional markets as well.
For sure.
Yeah, that's a very good point, and I wonder which direction that will go in. But while we're on the topic, quickly before moving on, of course, to what I'm sure a lot of people are here to listen to, there are a lot of misconceptions among retail traders as to what the functional role of a market maker is. Sometimes that term in itself will bring up all these negative connotations of someone, wicking you out of your leveraged position before the market moves away. This evil entity which is supposed to make life difficult. Of course, the truth is not that. So for those who want a professional understanding, or from the horse's mouth, so to speak, of what the role of a cryptocurrency market maker is, what would that be, or how would you clarify that?
I'm reminded the Reddit forums. I love to lurk there because people were going nuts about market makers, and they had, back in the day, the OKCoin wood chipper. They would kind of take retail traders and put them in the wood chipper, and I love those memes. And I used to be like a bit of a troll and talk shit on those forums, especially like Bitcoin markets on Reddit. And I remember, well, no one's got my handle. No one knows who I am there, thankfully, because I talk too much shit, except for my good friend Zain Taket, who's at FTX now. And so he likes to, from time to time, sort of bring up some stuff I used to say on the forum. And the people that were really going crazy about the market makers. But if you want to know what a market maker does, think of what I was facing on eTrade.com. I needed to trade, and then there was no one to trade against because the guy had given up. Well, someone's got to do it, right? Like if you're gonna put some prices up on an exchange, it just doesn't happen that two people randomly meet at the same time, one buyer, one seller, and they know what the price should be. So you can look at it from first principle. Maybe like you're not really looking to go long or short Bitcoin, but you're seeing that someone's got to put those prices up on the platform. So what you do, you say, well, I think the price is worth X, I don't know, Bitcoin 45,000. So I'll place a bid below that. I place an offer a bit above, and I guess maybe I'll buy, maybe I'll sell. I don't know. If someone happens to come and sell to me, I'm going to be slightly long. Maybe I lower my price a little bit so that I can get rid of my inventory. And then maybe someone's going to take me out. Then I capture a small profit. Hopefully the price doesn't move in the meantime. And I just keep doing that. And you see that it makes a bit of money, especially in a nascent, inefficient market. But then other competitors start doing that. You need to get more efficient, more automated. So you start coding up, you start getting the market data automatically, posting orders automatically, having some simple rules. Then everything gets more complicated. Then you start needing more balance sheets. So you're going to increase your balance sheet, borrow some coins, borrow some fiat so that you can put up bigger orders on the exchanges. Then you're going to have multiple exchanges where the prices are not necessarily going to be in line. So you need to take that into account. How do you aggregate different exchanges to figure out what the right price is, some sort of mid price around which you make markets? So you can really think of it iteratively. And when you think of it like that, it doesn't sound so nefarious. Of course, it becomes extremely sophisticated in a more mature market. And now the Bitcoin market is actually quite sophisticated in that respect. In fact, if I've got one piece of advice for retail traders is when you get started, it's pretty better that you actually that you cross the bid offer, especially on certain platforms. Like you take a BitMEX. On a BitMEX, it's not a good idea unless you're really experienced to actually place passive orders at the top of the book in order to capture the rebate. Because when you look at the microstructure of BitMEX, it's an exchange that has a high tick size, meaning that the minimum price increment is actually quite big. It's 50 cents, which obviously now that Bitcoin's so high doesn't seem so big, but you have to remember, it was like that when Bitcoin was $3,000. So that was a big increment. And at the same time, you get a rebate. So capturing that bid offer, being at the top of the book, making markets buying, selling, it's very valuable. So what you find is that the fastest HFTs, they actually compete on speed to be the first to be there at what we call the top of the queue. Because when you've got the top of the book on a BitMEX, I don't know, bid 45,000 and 45,050 cents offer, there's actually lots of orders there, right? It's not one single market maker, but when there's a trader that comes and takes against the orders in the book, it's the player that got there first that's going to be filled first, right? And so the dynamic that you find is that if you're a retail trader, you're not going to be fast. Even if you have like an algo trading system, it's not going to be as fast as the fastest player. So you're always going to be at what we call the back of the queue. And so if you're at the back of the queue, you have to think of it very simply. You're only going to trade when the top of the book, the level you're sitting at, is going to be taken out entirely, right? Like unless it gets taken out entirely, if you're at the back of the queue, you're not going to get filled. And so if you're slow, you tend to only get filled when the market is actually moving a couple ticks, right? And that's what we call adverse selection. And so if you're a retail trader and you want to trade on BitMEX, I really recommend that you have a taker strategy there. Now, if you look at an exchange like a Binance, where the tick size is very small, it's like 1 cent. Well, if it's 1 cent, you don't really have like a stable top of the book. And you really see that on BitMEX, the market doesn't move often, right? It kind of stays at the same price level and it moves from time to time because of the tick size. But on Binance, because it's only 1 cent, it moves all the time. It's like random. It's very volatile. So if you place an order kind of around the top of the book, you're actually maybe just sitting between two other orders. You're not in a queue, right? You're not like behind dozens of HFTs in big sizes. And so an exchange like that, maybe it makes more sense if you want to run a passive strategy there, because you're not going to suffer that much from adverse selection as you would suffer from it on BitMEX. And actually, interestingly, when you look at the fee structure, people tend to think if the maker fee is low, then I'm better off being a maker. It's actually not true in my opinion, because if you look at the BitMEX, the negative maker fee, i.e. the rebate, actually incentivize HFTs to really put like big orders at the top of the book. But on a Binance, because there's no such rebate, it doesn't incentivize the real big professional market makers as much as it does on a BitMEX. So you're actually counterintuitively, if you make as a retail user without like fancy systems on a Binance, you might actually lose out on average less in adverse selection, actually because the fee is a little bit higher. So there's like a couple microstructure ideas for your listeners that also help understand the mindset of a market maker, and how actually you can maybe take advantage of that a little bit to lose less money against the bots. So I hope that's a couple of good examples that are useful for you guys.
That was super interesting. Yeah, I never thought about the Binance like that you actually make more by not getting the rebate. That's genius. Didn't even think about it before. I like it a lot.
It's
Thank
one of
you very
those
much.
feelings where whenever I trade with passive orders, like especially from time to time on FTX, where I think when the tick size is $1 on their perps, right? On the Bitcoin perp, it's $1. Whenever I get filled a limit order on FTX on Bitcoin, my stomach just sinks because like the chances that it's a good thing, you know, even just observationally from experience without your market structure insight, which is awesome. Just you know, seeing that reflected in my own trading as well. Like when I get in those large tick size contracts, whenever I get passively filled, you know, this creeping feeling that like, you know, it's almost a bad omen, the fact that you know, my position's now in effect. So I totally get where that comes from. I had no idea it was, you know, my strategies don't vary, interestingly enough, my order types according to the tick size. But that's definitely something both for us and also our listeners to look into. So that was awesome. Don, I think we've got some homework to do.
Yeah, it's great that you have the right intuition. And actually, the mirror effect of that is the taker fee. Actually, the higher the taker fee, what it means, it actually makes it worse for the makers, because on a BitMEX, in order to cross the bid offer, a fast, sophisticated like quant fund would need a big signal that's more than the 7.5 bits that last I checked it costs to take on BitMEX. And so when the market moves, it does move, right? And so you also have to consider, okay, how big is the edge that the taker needs to have in order to think that it makes sense to go and lift my order. That's kind of like the mirror effect of what I described earlier.
Yeah, that's where the big moves come from then. Like the no moving into big move. Right? Yeah.
So counterintuitive yet so logical. It's one of those things, right? Definitely something to pay more attention to. That's awesome. I'm sure. I mean, I'm very grateful for that. I'm sure our audience will be as well, looking into our strategies. I think generally in crypto, kind of fees, tick sizes, all of those structures generally get overlooked a lot on the retail side of things. Most of the analysis tends to be, well, how cheaply can I take? Or even on the other side, it's like, oh, well, I get to make a rebate, so I'm just going to try to do that to lower my cost of trading. And it seems like a lot of the times the opposite can actually be true, which is super interesting to look into. Fantastic. If everyone's comfortable, I'd like to move on to discuss the hot potato of the week, or of the last couple of weeks, which is GBTC. So, you know, this isn't a product which I imagine a lot of our audience will be actively trading, but it's one that will inevitably come up on their radar, both on the way up and also on the way down when it comes to Bitcoin's price movements. So Premium was running hot, and normally GBTC trades at a premium historically, and then, you know, the same headlines come out when it trades at a discount or negative premium. I want to kind of start from first principles when it comes to this product before looking at the maybe implications of the premiums, discounts, who's affected, does it mean anything, etc. So you're obviously on the institutional side. What is GBTC, and why would an institutional investor want to get Bitcoin exposure via this instrument as opposed to just buying Bitcoin outrightly?
Yeah, and mate, I can go out on that topic for hours. So you stop me if you think we're going too deep, right?
Certainly.
Without being, I'm not a total expert on that, right? Because, you know, you've got asset management, that's one big field. You know, market making, that's another one. But Anyway, so GBTC, it's a fund. It's a fund, so people can pool their money and invest in Bitcoin together. There's obviously an automated way that it actually happens. Is you buy it in the markets. That's one way, or you actually bring in Bitcoins, and there's what's called a creation in kind. So you get shares in return for your Bitcoins. But if you go back to basics, it's basically like a normal ETF. Which everyone knows what's an ETF on your channel. There's one slight difference though. It's not actually an ETF, meaning that the way that you create or redeem shares in the ETF, you actually can't do that as smoothly with a fund like GBTC. I don't know exactly what the terminology of what that specific type of fund is called, but the way to think of an ETF is that it tracks an underlying asset, and in order to keep the price in line, well, we know that different products have different mechanisms, different funds or derivatives. They have different mechanisms to keep the prices in line. In the case of an ETF, you've got arbitrageurs that when the price goes above the value of the underlier, they sell the ETF and buy the underlier, and vice versa, they buy the ETF, sell the underlier. And of course, if you do that, you can accumulate big positions. You can be like super long an ETF of, I don't know, like a S&P ETF, and then you're going to be short all the individual constituents of the S&P, and you don't maintain a huge sort of offsetting position like that. So with an ETF, you can actually take your, if you've got shares of the ETF, you can go to the ETF provider and you can say, hey, actually give me an equivalent amount of the shares of the underlier in the S&P 500. And so if you do that, you've got shares of the ETF, you're short the actual individual stocks, and when you go to the issuer, they give you the stocks when you can use the stocks to pay back your shorts, right? And so that's the mechanism that keeps an ETF price in line. That's the big innovation of an ETF. It's that mechanism. But with GBTC, my understanding is that it's just they didn't get the approval to be a full ETF. That's the big, elephant in the room. We don't have an ETF in the US for Bitcoin. And so what they did was some sort of a halfway house where you can create on one direction, meaning you can bring Bitcoin to the table and they give you shares of the fund, but you cannot do the other way around. All right, and that's going to be, as you'll see, quite important. So it goes only in one direction. And the second important feature there is that, whereas for an ETF, when you actually do that creation or redemption of the underlying basket, you get basically the shares, or the exchange happens like T+2 or within some short period of time. With GBTC and all funds of that sort of flavor, there's a lockup. You have to wait 6 months. So if you come with, and I think it's approximately 1,000th of a Bitcoin per share, if you come in with 1 Bitcoin, they give you approximately 1,000 shares, but you can't sell them until 6 months have elapsed. So that's going to be quite important for the rest of the discussion. So far, so good?
Yes,
so far, so good.
I think that's very clear. For those also listening, one of the reasons that GBTC may be the preferable or the preferred way for a certain type of investor to get exposure. I mean, not only are there potential sort of built-in tax benefits, but also the custody gets taken out of your hands, as far as I know. Actual Coinbase custody, I think, does the custody solution for GBTC's Bitcoin. So all of this kind of security and storage, and is it IRA eligibility, etc. All those benefits come with GBTC. So that's potentially just flagging up some of the extra bits and bobs that may affect one's decision making when it comes to how to gain this Bitcoin exposure. And obviously, when it comes to the customers, it's those people who stand to benefit from those mechanisms. So one of the things you mentioned is essentially the redemption mechanism, or the lack thereof. I think I really like the term halfway house. You can essentially create in kind but can't redeem. What are the implications in your mind of the lack of a sort of redemption mechanism? And is that why we see GBTC trade at a premium or at a discount relative to the underlying?
Well, I think it's been trading historically at a big premium. So I think you have to go back to what you had just said. GBTC is kind of an all-in-one. It's good because, first of all, it's the oldest, I think, or more or less one of the oldest funds. So it's got that, it's got a good reputation. Just longevity, right? Just longevity. It does the custody. Obviously, the fund does its own custody, so you don't need to worry about that. It's also tradable with any sort of brokerage account because it trades like on the pink sheets, right? Like the stuff you see in Wolf of Wall Street. And that I don't say that in a bad way at all. Just like the small
Yeah, for sure.
stuff. Yeah. And it's tax efficient in some contexts for US citizens with retirement accounts. So all of that makes it like quite interesting. And in fact, just the tax aspect, it might mean that it actually always trades at a premium, because if you can buy Bitcoin exposure and actually it's going to be better taxed at the exit, well, maybe actually you're willing to pay a bit more for that, right? So that in and of itself might justify a bit of a premium. So all of that, it kind of makes sense that product would have a premium. It does, right? I mean, it just is the first. It's so it's got big inflows because it was the first, tradable in the US, tax efficient, yada yada. So that kind of makes sense that it would have a premium if you just start at that point. Now, what you mentioned, the fact that you can create but not redeem. Look at another product that depends on a similar mechanism. It's a bit of an analogy, but think about the BitMEX swap and all the perpetuals, right? You guys all understand, because you all trade the perps, that when the price goes out of whack, if it's too high, the funding is expensive. So if you're long, you pay, and if you're short, you get paid, and vice versa. So that just incentivizes people to take the other side when the market goes out of whack. Yeah, that's clear, right? Like you guys all are super familiar with that. Now, imagine that on the BitMEX swap, it only worked like on the way down. So if the price is below, you get paid to be long, but if the price is too high, you don't get paid to be short. Well, just like naturally, on average, the price would be a little higher, right? It makes sense, right? Like if the mechanism that keeps the price back in line, it only works on one side of when there's a discrepancy, then on average, it cannot really undershoot, but it can overshoot. So on average, it's going to be a bit above. Okay.
Mm-hmm.
And I think that's how I also think of GBTC. If you can only create, but you cannot redeem, you would think that in a lot of circumstances, it would actually trade not in line exactly with fair value. But now let's consider the actual direction of that. We all agreed just 2 minutes ago that the tax efficiency, the fact that it's a long-standing fund, yada yada, it's got like 30 billions under management now. Well, you would think, okay, it tends to trade at a premium, all right? But think of the asymmetry between creating and redeeming baskets. So if it actually trades at a premium and you can create a basket, the trade there is that you take some Bitcoins, you bring them to the fund, they give you shares at what we call NAV, which is the net asset value, which is the value of the underlying Bitcoins in the fund. So you bring some Bitcoin, they give you an equivalent amount of shares calculated at the NAV, which is like a number they have to calculate by law every day. And if it's trading at a premium, well, now you've got the shares that cost you the real price of a Bitcoin that maybe you bought on Bitstamp, let's say. And now you can sell your shares. But see, so if you can sell at a premium, then you're making a profit. So that mechanism where you can create baskets in kind, where you can bring some Bitcoin and get shares of the fund, it's a route for arbitraging when the price of the fund is too high. So we've got an interesting dynamic there. At the same time, we said there's good reasons that the fund would trade at a premium to its the actual assets that it owns. But at the same time, we said there's a mechanism when it does trade at a premium to bring the price back in line. Now, the other way around, it actually doesn't work. Because if the fund trades at what we call a discount to the net asset value, what you would do then is you would actually buy shares of the fund, and you would ask the fund, if it were an ETF, here's 1,000 shares, please give me a Bitcoin. All right? And so you would do that arbitrage by buying the fund at a discount. So it would be maybe, let's say, like it's trading at $38,000 or something like that, or the equivalent of $38,000 per Bitcoin. So that would be roughly like 38 actual dollars per share. So you buy them at 38, you go to the fund administrator and you say, give me Bitcoins. And the Bitcoins, you then sell them on whatever exchange you like at around like $47,000 or something like that. And you're making that profit between 38 and 47. But that mechanism actually with GBTC, the fact that it's not an ETF, that does not exist. And so it's really interesting that you've actually got strong reasons that the fund would trade at a premium with a mechanism to make it not trade at too much of a premium, but the other way around, it doesn't really work. So you've got that sort of weird situation where like it's a good trade to actually do that arbitrage, but until it doesn't. And when it doesn't, there doesn't seem to be much in the way of an actual mechanism to fix that discrepancy between the real value of Bitcoin and where the fund is actually trading in the market. Does that make sense?
Mm-hmm.
It does, yeah. Don, I think you want to ask something. I've also got a kind of comment. We've seen so the one, the fact that it only works in one direction, at least from a mechanistically. We saw the premium, or I suppose a discount, appear in the market, which peaked at, or the premium went to minus almost 12%. I think I've got 11.92 on my screen, and it's kind of recovered some of that. Most recently was minus 3%. If the mechanism for the other way around isn't as explicit, so going from discount back to baseline, if you will, so we've got a way of pulling the premium down, but there's no explicit way for the discount to trade closer to where it should be, if you will. How does the market kind of correct in that regard, as we've seen recently? How do you interpret the closing of the discount that we've seen recently?
So let's answer that question, but then we'll have to consider why there's a discount in the first place now,
Certainly.
right? I mean, we understand why there was a premium, and now we'll have to discuss why there's a discount. But what's the mechanism that we could have? Well, that's where I'm really interested in what you guys have also heard in the market, because everyone's got a different opinion on that. There's different ways that it could work. Some people say that it could be actually converted to an ETF at some stage, in which case that mechanism would then start existing. I do not actually know what it takes to turn a fund like that into an ETF. I don't know if it's likely or unlikely, but that would be one way. It may be possible to actually have the other mechanism be put in place. My understanding is that they have a trust charter. They have some sort of governing documents. The fund, they will need to change that. And I imagine there's a governance process there. Maybe they need to get people to actually vote, whoever owns shares of the actual fund. It's pretty complicated, to be honest. ETFs and vehicles like that, they're not meant for the people who actually have stakes in them to change the governance, right? It's not meant to do that. But that would be one possibility. It does beg the question, though. I don't have the answer to that. Would really love to know what's what. Why didn't do that in the first place? There must have been a reason, right? Because if you think of such a fund, it kind of seems like a better design to have the bidirectional mechanism. So the fact that they didn't do that in the first place, they must have had a reason. Maybe it was easier to get the approval like that, which is kind of weird because when you think of it, it's not good for traders and investors that mechanism doesn't exist. But the ways of the SECs are maybe complex. And
I think they tried. If my understanding of the history is correct, they actually had to set. Mm-hmm. They tried to have a redemption mechanism in 2014 or something, or like an effective redemption mechanism. But then they had to. I mean, they got a slap on the wrist from the SEC, and then they had to settle and basically cease and desist their version of the redemptions. So I think it ended up being by necessity that it did actually start off, again, if my reading of the history is correct, I haven't got the documentation immediately available, but from the research I was doing for this call, they were offering a form of redemptions initially, but then, I mean, the SEC made them stop, which is maybe explains the asymmetry that we see right now.
That's really interesting. I didn't know that. Well, let's think of other ways. I guess some people say that so Digital Currency Group, which is that very big sort of a conglomerate of crypto companies run by Barry Silbert, that they could buy back shares in the fund, or it's not really a buyback, but I guess just buy outright to try to bring the price up. But it seems like that's like you need unlimited firepower to do that. So I'm not sure if it's that realistic, but I've also heard that.
Yeah, I mean, there's going to be a speculative play, right? Where you're like, okay, this is such a discount that just makes sense to get. But then you're kind of gambling on a redeem feature being implemented, right? Because if you don't, you're going to be stuck in it. And yeah, if nothing really happens, then you just bought something, you can't get rid of it, really. Price not going to go up if people, because as far as my understanding goes, there's a bunch of funds and a bunch of people that got in for the arbitrage play, right? For the play of, okay, GBTC is trading above Bitcoin. We're just gonna do this, buy a bunch or like get a bunch of GBTC, and then kind of pocket the premium.
Yeah.
And then that site got so oversubscribed that now you have a bunch of people just trying to get the premium, but it's trading below actually. So you're kind of stuck with a position that you don't really want because they're just looking to kind of make money off of the premium. And then like that's how I kind of make sense of it going that far into the negative. It's just people getting out, just kind of taking their losses on the position that they originally just wanted to kind of make an ARB play on.
Yeah, that's right. Yeah, sorry, go ahead.
Yeah, do you agree with that view, or?
Yeah, I think what we can do is we can so kind of explore that big premium, that big trade, and then we can consider that, go back to the fact that it's at a discount, and maybe, okay, what can we do as traders to maybe try to take, is there a trade there that us folks can do? So maybe we'll explore that second. But first, so yeah, the premium trade, what is it? We all agree that there are some reasons that there might be a premium, and so you want to arb it. Actually, the premium, maybe you guys have the chart there. I mean, it went to like up to 50%, like really high premium. And when you think of that, it's like when you bring Bitcoins in, and then you get shares that you can then sell, you've got a 6 months lockup. So if it's trading at a 50% premium, you're actually looking at a return of 100% a year, because you make that 50% in 6 months. It's quite high, right? And so a lot of clever funds started doing that in big sizes. Some of them have been public about it. I think, well, Three Arrows Capital, they mentioned that. Those guys are really smart. And I think they were pretty early in that trade. I have to admit myself, so B2C2, we didn't do that trade because we thought it was a little bit unclear, that sort of mechanism, the way it would actually work in the other direction. Also didn't have necessarily a balance sheet that we wanted to commit to that compared to other opportunities. Also, you have to go through actual normal brokers, like interactive brokers, which can be a pain in the butt. Also, I thought personally, I'll admit, bad take there, but I thought it was too good to be true. I simply thought it's too good to be true. And the sort of explanations I got from the people, some people also were pitching that, telling people, hey, why don't you do that? Also, you can think of it, people at Grayscale, they want to increase the assets under management. So they were actually telling people, there's that trade potential you could do. And it was too good to be true, in my opinion. And also the explanations I got, they were not so convincing at the time. So I didn't do it. In hindsight, obviously, I should have done it, or rather B2C2 should have done it at the time, but we didn't. Others did. And you have to fast forward a couple years where GBTC has become rather mainstream. There's a big player that got into that ARB. And I think this is really important. We talk about this because it goes back to actually the ascension of the DeFi lending sort of new moment that we've had since roughly like late 2019. So I've been thinking about this. There's a big player that's been doing that trade. They're BlockFi. I think most of your listeners are going to learn about them, or sorry, know about them. Now, I think I want to state first that I like the guys. I think they're maybe in a bad spot, and I wish them well. I hope that they end up doing okay on the trade. But it is the case now that the trade isn't doing so well. And I think that the fact that, like, I like the BlockFi guys, we still have to talk about that trade, right? I think even if we're like, we think it's kind of sad that they're stuck in that conundrum, we still have to be able to talk about the trade, even though we're kind of talking against their book, because obviously the worse the discount becomes, the worse for them it is. But I've decided that we need to be able to talk about market issues, even though the folks that are experiencing them, we like them and we're close to them. So I just wanted first to sort of quote unquote disclose that.
For sure.
So let's explore this. BlockFi is a company that borrows Bitcoin and other cryptocurrencies, and they pay you a yield on your holdings. The yields have actually been quite high, and there's two ways that those guys can make money. One way is that they borrow from some holders, and then they lend to some other folks that would need to borrow the same assets. So it could be like you borrow some Bitcoin from a retail hodler, and then maybe some market makers, some quant funds, some whatever player needs to borrow Bitcoin. So they're borrowing Bitcoin. Maybe they want to go short. I don't know. And so both of those sides are going to have a yield. So you capture the difference between the yield at which you borrow and the one at which you lend. Okay. But to me, especially considering the sizes that they're talking about, I mean, they've got billions of dollars in borrowings, and what I know to be the size of the institutional crypto market, if we're just talking about like quant funds and market makers, I'm like, there's no way that if those guys borrow at an average of like 6%, they're able to lend as much as like $1 billion of Bitcoin at like, let's say 10%, and certainly not whilst maintaining some sort of not too risky book. Because when you lend to people, you'd have no guarantee that they pay you back. So you also have to account for defaults, bankruptcies. So that's been quite puzzling. And I think now a lot of people in the industry understand what's been happening. Actually, what's been happening is that BlockFi, and they made that public because you have to when you start doing trades with funds in big enough sizes. What they've been doing is that when they get Bitcoins, they actually do that ARB or pseudo ARB, I suppose, with GBTC. So you're a retail hodler, you put your funds on BlockFi, they pay you 5%. BlockFi takes your Bitcoin, and then they go to GBTC, they do the creation of baskets, and then they wait 6 months and they sell at hopefully a premium. So that's just the trade that they've been doing. And based on their filings, they're above $1 billion now. So that's quite a big size. And now it starts to make sense a little bit, right? Because if they're making like 50% or even like 20% every 6 months, that's a huge return. And if you do that on $1 billion, then that can definitely subsidize the rest of your business for like $2, $3, $4, $5 billion. If what you're paying is around 5% to your lenders, and you're making like a 50% annualized return, thanks to GBTC, right? So actually, what's happened is that I found it puzzling that the yields were so high, but now in hindsight that they've come out and said that they were really big in the GBTC trade, it kind of makes sense, right? And the way that they disclosed it is that they had to file a form with the SEC called a 13G that you have to do if you own more than 5% of a fund. And inside, it contains of many shares they have. They've got 30, well, at the time that they had to file, which was as of year end, so 31st of December last year, you have like 45 days or something. So they published that like a month ago.
Yeah, I've got it up for the audience who are watching the video. Yeah, it's a 5.66% ownership.
Okay.
And yeah, it's 36,156,000 shares, just below Three Arrows, which is at 6.1% with 38,888,000. So yeah, that's when you cross that 5% threshold, I think that's when you have to make that filing. So the date on this is the 12th of February 2021, so very recent.
Yeah, so that's more than $1 billion. That's right. Yeah.
Yeah.
Now the problem that we have here is that there was a premium for a very long time, and sometimes people can think that those, like the structure you have in the market, is going to persist forever. But a big driver in the disappearance of the premium now is that there's competition in the asset management space in crypto. You used to have GBTC as the only game in town. There's a Canadian ETF. Also CoinShares in the UK. In UK, they've got their own products as well. I mean, it's a broader marketplace now. You've got different options, and so if you see GBTC trading at a 20% premium, no matter the actual tax benefits, you're just going to invest in something else, right? And so naturally, that brings all the potential premia that all those products would have more in line and overall slightly lower across the space, right? And so the thing is that doesn't explain the premium being minus 15-ish%, but it might explain the premium being slightly lower. Now, what you have to factor in now is, I think something a lot of your listeners are going to be aware of, is the sort of cascading problems you've got with like cascading liquidations, right? It's that some people have a position and then they puke, and it doesn't matter that the market doesn't really move that much, but when people start puking, then the market orders that are generated by the exchanges, they push the market further, and people keep puking in cascade. And I think that's possibly what can happen on GBTC now, because there's actually a cost to owning the assets, right? There's a cost to owning GBTC. It's 2% a year. Okay, that's not that much, but there's something. Also, if you take the position of BlockFi, well, what they borrowed in Bitcoin, it's not free, right? I mean, it's again something like 5%. It's not so bad, but it adds up. You have like the 5%, the 2%. Maybe they need to have like collateral to some people. Maybe some of the loans are collateralized. So there's like a cost to everything there. So the thing is that if you look at the premium, and it used to be at 20%, but now it's at 5%. Well, guess what? You're actually not breaking even. And so that can force some players to actually be like, guys, we need to take the L here. We need to just go and exit this trade, maybe even before other people exit this trade, right? And that starts to be some sort of like a game of chicken, because I'm pretty sure that if you wait, well, I'm not pretty sure, but it could be that maybe if you wait a year, it goes back to flat. It goes back to no premium, no discount, and then you can exit at a better price. But it may also be that it goes to minus 15, minus 20, minus 25. Who knows? And at some point, there's a risk officer, an investor, someone's going to tap you on the shoulder and be like, now you need to close this out, right? And so there's also that game of chicken where even if the premium might still be positive now, a lot of people are exiting, and that's putting a lot of downward pressure on the GBTC premium, which is now a discount. So there's like that's a double whammy, really.
Yeah, the situation is it's kind of crazy, because it's just off of, I would say, over leverage. Again, it's kind of like the core issue with a lot of stuff that happens in crypto, where it seems like a sure bet, and then people over leverage, and then it starts like turning, and then people get wrecked. So could you see that kind of cascading even further than like 10, 15, 20%? Could you see it go to like 30, 40, anywhere there? Or do you think this is as much as it gets?
Well, I've asked one of my guys, actually, who used to be at one of the big ETF market making shops, like conventional finance. And he said that even in quote unquote legacy products, you could see stuff trade above or below net asset value for years on end, right? When some of those special situations occurred. So I don't know. I think it could have more room. Now, I've actually personally, I bought some. I thought, okay, minus 15%, that's a good discount. So we'll see what happens there. So full disclosure. But yeah, it may be that it goes to minus 25%. Who knows? I think time will tell. It also depends on the situation of the players that have got that trade on, right? If you're a highly capitalized, big company with a huge balance sheet, and that's just a fraction of what you do, then maybe you keep it on. Who cares? But if that's you kind of rely on that, it's difficult. There may also be some sort of like a vicious circle, because the pain point, if you're doing that trade where you borrow Bitcoin, do the GBTC the pain point is higher price but no premium. Why? Because if there's no premium, you have to wait, and you have to, and you need to wait until there's a premium, and otherwise you're locking in losses. But also, a higher price means that if there's any chance that some of your loans are collateralized, think about that. I'm borrowing Bitcoin from you, DonAlt, and I'm giving you Tether in return. Well,
Mhm.
as the price goes up, the Bitcoin that you lent me, they're worth more. So you're going to ask for more Tether collateral, or more whatever collateral it is. And if that's the case, well, I need to find a way to actually deliver that either fiat or stablecoin collateral to you. And if I'm doing that trade in a big size, well, really the only way that I have is by actually exiting the trade at a loss a little bit, right? Maybe I have to sell some of my shares that have come out of lockup, and I'm losing money, but that's that, or you call back the loan and I just blow up, right? So that's a real problem, I think, that dynamic where at the same time you've got the price that's really high now and there's no premium. You can also think of it as a correlation trade. People have pretty also been thinking, well, if we do this trade, then yes, sure, there's a risk that we get some margin calls on our collateralized loans, but if the price goes up, that's when we're going to get those margin calls. But at the same time, the premium is pretty going to blow up as well. So we're going to make a ton of money. So it's probably not so bad. In finance, that's what you tend to call right way risk, right? When there's a correlation between two things, and when there's a risk that materializes on one dimension, you're making money on another dimension. So it's kind of not so bad. But that's a correlation trade. So the correlation can go the other way around. And I think that's what we're seeing now. You've got Bitcoin at 50,000 at sort of the tail end right now of a huge rally. And at the same time, the premiums all but disappeared and it's negative. So I think that's also something that they did not entirely, well, some participants did not foresee, in my opinion.
Yeah, I could definitely see that. With the trade that you've put on, what have you kind of figured out are the risks? So time-wise, if it takes too long, you're paying, right? So
Yeah,
you have your
2% a
pay.
year.
Yeah. And then it's also, okay, is it even gonna go back? I mean, I would assume it's going to at some point, but I mean, there's no guarantee, right? As long as they're not adding a redeem feature, or if it doesn't turn into an ETF, like it doesn't have to return to neutral, right?
Yeah. I think that, well, I did a small size, right? Just PA. It's not B2C2, by the way, just me on my own account.
Mm-hmm.
But I figured, okay, well, minus 15% at 2% a year, you got a couple years that you can sit it out, right? I mean, sure, there's the cost of capital for you, you're locking up funds, but you might actually have, maybe you're out in 2 months, and that's a nice return. But if you're out in 5 years, I mean, yeah, you'll have lost most of the profit in management fees to the sponsor, but it's still not so bad, right? I reckon at a slight discount of like 2 to 4%, yeah, maybe it's not so great, right? And I mean, obviously not financial advice. You guys do your own research, but there's a level at which you feel like you can sit it out. I think if you look at the very long term, the risk is that in reality there might not ever be a mechanism, and if there's no sense that there will ever be a mechanism, I think what happens is that it's going to go, I mean, the discount might go to like minus 80%. And in that case, what happens is over the next, maybe, basically roughly 50 years, so Grayscale, the sponsor, is just going to capture the 2% fee every year, year after year, until the fund is basically empty. And that's actually, interestingly, to your listeners who want to look at this, the way to see the impact of the fees is that the net asset value is a number of Bitcoin per share. It used to be 1,000th of a Bitcoin per share, and every time they deduct the fees, actually the number of Bitcoin per share, it goes down a little bit. That's kind of how they actually take the fees out, right? It's
Yeah.
interesting. You can look it up on the website. But so they might actually just take the fees and that's it for the next 50 years. So the trade is also that you're kind of betting on the value of the reputation of Grayscale and Digital Currency Group, because if that really happens, I mean, that's the end of the reputation. it's just not good, right? So a lot of people also feel that something's got to give. It can't be. I think someone on Twitter, Austerity Sucks, said it's a failed product. It's a failed product. So you've got to do something if you want to keep, your reputation intact and your other products that you have, because DCG, it's a big group, actually credible. So I think that's also a bet that you're making. And personally, I feel, I felt comfortable about enough about those guys that they would at some point intervene in one way or another, and that there was enough runway, so to speak, in terms of the discount, that it made sense. But yeah, you got to do your own research. By the way, I made a mistake. One that I mentioned earlier on the podcast, sorry, on the video, is that I actually placed limit orders because I was a bit greedy. I was like, nah, it's volatile. The bid offer is quite kind of big. So like, I'm just gonna sit at kind of around the bid, right? And then price was like $30, got filled a little bit, and it started going back to like 39, 40, 41. I was like, crap. I should have crossed the bid offer. So classic mistake, right? I thought I was more clever than the market makers there, Citadel and the like. Actually, I wasn't. So even if you do that for a living, you can make silly rookie mistakes like that.
Yeah, I find the entire situation super interesting because, like you said, with the reputation, I find it very unlikely that nothing happens. But then again, if you think about it, the more kind of shares they have outstanding, or like in general, the more money they make, right? So
that's right.
So they kind of like if they're giving people the chance to redeem, and then you have less shares out there, you're obviously going to make less money. But I still think I kind of agree with you there. I'd be very surprised if they're just betting or like losing, or if they would be willing to lose their reputation over something like this. If anything, it would be probably a regulatory issue, right? Like Cred said earlier, if they can't make it happen, then you have a situation where they probably would like to, but at some point, like if they can't, what happens then, right? And then I could see like it go really bad. But who knows if that's where I'm like, okay, you need a super expert for that, and I don't think there are really any that you could ask if that can happen or how likely it is. So it's basically just a bet on, okay, how reputable are they and can they kind of fix this issue? And I have no answer to that. I really want to get into that trade as well. But for me, it's been really hard to figure out like how much at a discount has to be for me to get like involved. Because in the end, like what I plan to do is just sell some Bitcoin, buy some GBTC, and then just ride it out.
Right on.
But it's like if you think about it in crypto, if you put your money somewhere and in a long-term play, maybe it takes like 2, 3, 4 years till you get out. It's kind of, your money is not necessarily working elsewhere, right? So you also have to consider that fact, that you could be doing something else with your money, and it's now stuck in something that's not going to move for a year or two. So yeah,
but I think you're thinking about it the right way, because that's the simplest trade. And if you're a Bitcoin hodler anyway, maybe you sell some and you buy back the same amount via GBTC, and you were gonna hang on to the coins anyway, probably, right? So it doesn't matter if at least those are your circumstances, that you need to wait maybe a year or two before it goes back to flat. Yeah, I think that's probably the easiest trade and might be a good one.
Yeah, I mean, sorry, Craig, go ahead.
Sure. I mean, I'm just saying, I wouldn't just observationally, I wouldn't mind if this spurned some positive regulatory change, seeing that the ETF denials have created this set of circumstances where you kind of have this, as you mentioned, I love this term, halfway house of an ETF. We have then big players getting trapped in this arb trade, and then maybe that has systemic risk for crypto. I mean, that's a slightly more far-fetched argument, but, there is a mechanism for it. Maybe that's the needed catalyst to say that you've got this 30 plus 36.5 billion AUM kind of de facto ETF, which doesn't have the necessary the regulatory structure to be an ETF, maybe we can actually work towards a real one to avoid these types of issues, and kind of everyone's better off, especially with more professional, bigger sizes, institutional participation. I just think it kind of sets the scene quite nicely for a product which actually does its job. I mean, there's precedent in Canada. That ETF seems to be very popular, although I haven't read the exact technical specs. I just wouldn't mind a happy conclusion to this where we actually get one, if that makes sense.
Well, for sure, Craig, if you look at from a sort of investor protection perspective, which I understand is one of the roles of the SEC, is you've got people that are a little bit levered on that. They're long that thing on margin, and so if the premium goes negative, even if Bitcoin doesn't go down, like some people might be margin called, although quote unquote their thesis was the right one. Bitcoin might stay where it is, but then if the premium continues to go lower, yeah, people might get liquidated. I mean, I don't think that would be a good outcome, right? I mean, it just seems kind of very unfair and a flawed design to have a possibility that your underlier actually doesn't move, and you get closed out at a big loss. That just doesn't sound right to me.
Yeah, fully agreed. I mean, I've in general heard of whispers in the bushwork that it might become the first one. So they might convert it, but it's always like in crypto, it's kind of weird. You hear those whispers, and then at some point they kind of come true. It's the same with Tether, where I heard a lot of people talk about that the news is going to be kind of okay. It's going to be a slap on the wrist, and then half a year later, it actually is exactly that, and people were just talking about it a lot. And then you have other situations where stuff gets talked about and it just doesn't happen, and you're just sitting there. But I mean, I wouldn't be surprised. It would just make sense, right? You have this thing already there. A lot of people are already looking into it, trading it, and why not just make it the first one if you want one at all? So the question becomes: do you want an ETF, a Bitcoin ETF, or do you not? And I think if you do, it makes a lot of sense to just kind of say, okay, Grayscale, go ahead, do it. And I think they would, right? I would be very surprised if they didn't take that.
Yeah, it'd be their saving grace. I mean, just looking at ETFs in traditional markets, you've got like the ARK, for example, which, there's a lot of criticisms of how liquid ARK actually is. Then Buzz, I don't know if you know the Portnoy ETF, which is supposedly this algorithm which balances according to the most popular stocks on social media. So it's not like the standards are like incredibly high for these instruments. And the past rejections have talked about the manipulated nature of Bitcoin, etc., etc. But if you're seeing this de facto ETF or trust with 30 plus billion, at a certain point, almost everyone wins if you let it function like one, and you avoid, as Max mentioned, all these levered scenarios where your thesis can be correct, but just because of the way it works, just the way the trust is set up, you get margin called or end up in tricky positions. It just makes sense to me as an outcome, but maybe I'm completely wrong. Interestingly enough, just on a very quick aside, I was going through the Twitter of the CEO of BlockFi, Zach Prince. He was answering a question asked by Ben Davenport, who says, BlockFi Zach, can you say what % of the GBTC shares that BlockFi holds are held for its own book as opposed to held as collateral? To which Zach replied, we sized our activity there appropriately and always expected volatility in the premium/discount. It's actually creating a new interesting ARB opportunity for some of our institutional clients now. Just another dynamic aspect of crypto markets, ! And that was today. Wow, earlier today, which is kind of the answer you'd expect. Not really saying much, but at the same time, I don't think it's probably in the best spot to speak in great detail with.
It's a very good point, actually, and I think maybe I was blindsided a little bit there. It is also possible, you can imagine that they're actually helping other people do that trade, and then they're just holding on to the shares as collateral. In which case, they would be exposed to the premium, but in an indirect way, in the sense that the people they help accomplish that trade, they actually need to, if they're underwater, they need to top up, and so they would only lose money to the extent that they're not able to close out the position of their clients, before they're too much underwater. Now, a question I would have then is, what does it mean for them to hold shares as collateral? So, I think you guys understand what it would be, right? some institution or whatnot, someone goes to BlockFi, they say, hey, I'm going to borrow Bitcoin from you, I'm going to do the GBTC trade, and I'm going to collateralize you with the actual GBT shares that I get, right?
Mm-hmm.
Now, I think the big question would be, are BlockFi actually allowed to hold shares as collateral on behalf of other people? And that gets kind of technical, but if they were holding shares as collateral, would they actually show up as being to their beneficial ownership? Like, so would they have to report, in the sense that if they actually had all of those shares, but they didn't buy them, or rather create them, they were just collateral held by counterparties, would it actually be reportable like that? You've got in real markets, quote unquote, that concept of title transfer. Title transfer is when you give collateral to someone, you actually give them the title to the asset. So they became the owners, like the real owners. They do have an obligation to return the collateral to you in the future, but in the meantime, you're not the owner of your own collateral anymore. You've given it to someone else temporarily. And so when you have the title that's transferred to you, typically it's like normal ownership, so you would have to report. But a lot of collateral agreements, they're actually not. They don't necessarily transfer the title. They transfer some sort of right to kind of capture the collateral if things go wrong. They give like what's called security over some collateral, and those two things are actually, they're different. So it would be a really good, interesting. It would be very interesting to know if the collateral is like that under title transfer, or if it wouldn't appear under title transfer. And I think maybe the answer would rely on whether BlockFi's got any regulatory licenses that would allow them to do one or the other. So that would be quite interesting to figure out, actually.
Yeah, it's the question of enforcement rights versus proprietary rights, which would be pretty. Yeah, I don't know how what their book looks like. It'd be really interesting. I think either way, I'm hard pressed to find like, as much as as positive as it sounds to say new ARB opportunities, etc. I think BlockFi's life and their partners' lives are a lot easier if there's just that premium and that traders in its most straightforward shape, as opposed to what we've been having more recently. But that's definitely one to watch. I personally don't yet see any great evidence of some massive systemic risk, but with lending, I might just be a bit of an old boomer in that regard, but I mean, crypto lending generally still makes me pretty uncomfortable. March made that very clear. Trustless or not, I'm not fully sold on those structures. I don't know what your thoughts on that are, Duck. Do you have any kind of high interest crypto accounts where you kind of keep your Bitcoin, or is it very much in your hands? Because I'm not sold on the idea yet. I could be closed-minded though.
No, for me, I just rather have Bitcoin. I mean, it depends, right? I always have an issue with, okay, there's no risk involved in this. When someone says, okay, yeah, this is free money, you just have to. It's the same thing where I like to disregard that kind of stuff and then miss out on opportunities. I was pretty much in the same position. I could have gotten in on a lot of the GBTC stuff. I mean, everyone was around. Everyone could have gotten in, right? But for me, it was like kind of scary hearing, okay, it's risk-free. There's no real problem involved. And I kind of get that same feeling for a lot of the lending stuff. Now, it's been really good, right? If you think about the last year, basically,
with DeFi especially, right?
Yeah, with after the March crash, it's been really good, kind of just making yield. And a lot of my friends have been basically doing that with USDT. You can do it with a lot of stuff, and it's been doing really well. But I've always struggled with it a little bit to just do it in big size. So I don't know. What do you think about, Max?
Well, I have a rule of thumb that's good for traders to keep in mind. Is that, and I used to be actually an interest rates trader focused specifically on cross currency, meaning the difference in interest rates between pairs of currencies. That was my big specialty. So there's always a high yielding and a low yielding currency. You take any two currencies, one's going to have a higher yield and the other one's going to have a lower one. And so what that gives you is the currency that actually is trading at a premium, like on futures, it is sort of by definition the currency that should have the lower yield. And that's like a bit of financial math, but people can figure that out from Wikipedia articles. But really what it means is that when there's a bull market and people want to go long Bitcoin, then the high yielding currency should be fiat or stablecoin. And the low yielding currency is Bitcoin. When it's a bear market, it's the other way around. The high yielding currency should be Bitcoin, and the low yielding or relatively lower yielding currency should be fiat or stablecoin. So in a market like this, where it's all the perps are trading at a premium, the futures are, you're not supposed to get a big yield on your coins, if any yield at all. And when it's a bear market, now you're supposed to get a bigger yield on your coin. You can think of it different ways. Maybe in a bear market, people want to borrow coins to short, yada, yada. It's all kind of one and the same thing. So big bull market, not supposed to get interest on your coins, but you can get interest on your fiat, and then vice versa. And the difference, if you do have a yield on coins, but we're in a bull market, then it means you're taking credit risk. It's just what it is. If there's a high yielding and a low yielding currency, but you look at an opportunity where there's a high yield that on the currency that's not supposed to be high yielding, then it means you're taking credit risk in one way or another, or you found a perpetual motion machine or something like that.
Yeah.
And of course, there are like slight exceptions to that, and you have to kind of look at the fine print. But in reality, right now, if you're getting a really high yield on your coins, you have to step back and think, well, what's the source of the yield? Who is paying on the back of that yield? And that's also what I kept thinking of BlockFi. I mean, how do they actually monetize those yields? Because I'm looking at the market, raging bull market, and I'll give the example of B2C2. I have B2C2 as like institutional crypto loans for coins at 1%, right? So that's what institutional players are paying for crypto now. They're paying, well, maybe some are slightly higher, but you're talking like down to 1%. So just saying, well, we borrow from retail and then we turn around and lend to institutions. Well, okay, but you look at the B2C2, 1%. Three Arrows Capital, they also said on different podcasts, they're also borrowing at super, super low rates, and that's unsecured actually, so with full like credit risk. Same with B2C2. So, the more institutions I speak to, the more they're not really interested in borrowing at like 10% just to get some coins when we're in a raging bull market. Of course, if the market turns, it's going to change, but like the current situation didn't make sense to me. And so understanding that GBTC ARB now, it's starting to make sense because, of course, if someone's looking to make like a 50% return in 6 months, they'll be willing to pay whatever, 5, 10, 15% maybe even. But really, where's that yield coming from? It's coming from that borrower's expectation that they're going to capture a huge premium. But guess what? That premium is not for sure. It's not a sure bet. And so part of that sort of excess yield is coming from that risk.
Yeah, very well said. I mean, it's always when the yields go really high, and I mean, people have seen that on the DeFi stuff. The stuff that has the highest yield usually just rug pulls at some point. It's just how this stuff works, right? I mean, you're taking huge amount of risk to get that, and I'm always surprised when people tell me, okay, I'm getting this massive yield there. This is so nice. And I'm like, okay, I mean, that makes me a little bit afraid because, I mean, if you're getting that high yield, you're getting it for something, and that is always involved. Like, you always have risk there because no one's giving you just free money, right? It's not how it works. So, I mean...
Were you guys big in the... were you around when we had the big wave of exit scams and things like that? Like around like 2017, 2018, we're like,
yes,
absolutely. I feel like the rug pull now, it might be the new exit scam, right? Because when you think about it, you would create like an ICO project and be like, oh, investing in my coin is gonna be amazing, and then you just exit scam like 10x and whatever. Yeah, those guys are funny. But now maybe what you do is you create a contract, you say, oh, super high yield, like send all your money, and then oh my god, we get hacked. But who's really doing the hacking, right? And you have to be pretty sophisticated to find the flaws of those contracts. I would imagine the best person to find a flaw in the contract is a person that's written it, right? I'm just saying, right? But maybe that like rug pull is the new exit scam.
Oh yeah, there's a lot of speculation with a lot of the rug pulls, exploits, whatever it may be. That some of them are just so sophisticated and require such intricate knowledge of the contract that the most, almost on an Occam's razor type of level, the most likely explanation or the most plausible one is that it has some inside element to it. So I think the rug pull exit scam just changes the mask it wears, but ultimately it's similar principles, like you mentioned.
Which one was the project that rug pulled, and then they had to get like scientists on to kind of explain how they did it? Oh, I forgot.
Oh yeah.
But
Oh god, I forget as well. But that's the one where they said only a team of researchers. Was it Alpha?
Yeah.
Was it Alpha? The one which said.
I don't remember,
It was one
but
of
yeah,
those. Yeah.
it's always when you can kind of count the people that could do the attack vector that they did, that to kind of drain it all. If there are like 10 people that can do it, I mean, what's the chance that there's someone on the inside involved with it, right? Very, very high. So yeah, I totally agree. I've always thought that is the most likely for most of them, just based on the fact that really, like with all these new projects, they're so cutting edge that there's really not that many people that could actually do it that quickly anyway, right? Because kind of getting into the project, kind of understanding how it works, and then finding a way to attack it is just so much easier if you actually set it up. Yeah, I totally agree.
Awesome. Max, you've been incredibly generous with your time. I've certainly enjoyed this conversation. I'm sure our audience has as well. Do you have any final notes you want to leave? Maybe some advice for new traders looking at the quantitative side, some wisdom, maybe where to find you. Anything you want to impart?
Yeah, for sure. I think that, we're having a really good conversation here, and that goes to the value of having like a circle of folks that you can exchange ideas with. As a trader, information is really well, for B2C2 kind of companies, we're just kind of working off algos and speed and whatnot. But if you're more of you look at fundamental, you're taking even on technicals, but just like longer horizons and just the next couple milliseconds, it's really valuable to be able to bounce off those ideas with others. And so I really value following you guys on Twitter. I think it's good for anyone who's looking to to make a bit of a living in markets like these, to have other people that they can speak to or just get ideas from online. Of course, you want to be mindful of people just shilling their books. But it's super valuable. So I really like following you guys on Twitter. If people want to see me run my mouth on Twitter, as I frequently do, they can follow me. I'm at Max Boonen with 2 O's, Boonen. And yeah, I also tend to talk about various stuff, or, used to talk about US elections and things like that and what we could trade on the back of that. Yeah, so very happy for people to come off and post comments on my silly tweets. And actually, I learned a lot of stuff recently on GBTC because I approached I hadn't looked at it, and then I got people to respond to my tweets and things like that. That was a really good source of edge, I would say. So if people want to do that, very welcome too. And other than that, I'm really glad you guys had me on your channel. Very good conversation, and I look forward to speaking to you again.
Awesome. We look forward to it as well. Don, thank you. Max, it's been great. We'd love to have you back. And to our audience, thank you for listening. Make sure you do all the normal stuff, like, rate, subscribe, etc. You know the drill. That's all from us, and we'll see you next time. Gentlemen, thank you again.
Cheers, guys.
Cheers.